Hi, I am Jeff Permet, and along with Nick Davis, we are the co-managers of the Libero Cautious, Dynamic, and Solutions portfolios. We started off January on a positive note, despite everything President Trump is trying to do and say that is destabilizing for the world. And I would say that's really the two strands of what's happening. You have a president in the United States who is breaking all the norms of geopolitical relationships that we have known for really, I guess, the whole post-World War II era. And at the same time, we also have good growth in the US, good growth in Europe, decent growth in the UK, no central banks really materially tightening rates. And there's really, I would say, very low probability of the need for the US or the Eurozone or the Bank of England to consider tightening. And in fact, at their latest meetings, the Bank of England voted 5-4 to keep rates unchanged, suggesting that their next move is probably going to be a cut. The AI spending continues, and we've seen in some of the earnings announcements that the scale of the spending is even planned to be far larger than we had estimated at the end of last year. I think the big four mega caps are planning to spend over $650 billion this year on AI CapEx. We've never seen anything like this, and that is spilling over into demand for electricity to power these data centers and requires upgrades to electric grids. It requires a lot more copper to expand electric grids and to distribute the power that's needed, and that has produced a surge in commodity prices. I should touch on President Trump named Kevin Warsh to be the next potential head or chair of the Federal Reserve Board. People are trying to figure out what he is. There was an initial reaction, oh, he's a hawk, and the dollar rallied and markets kind of sold off on that. But I think it's very difficult to envision a scenario, at least in the next 18 months or so, where Kevin Warsh would be pressuring the FOMC to raise rates. I think it's going to be the other way around, so I wouldn't expect any hawkish behavior from him. And it's worth noting that Kevin Warsh and Scott Bessent, the Treasury Secretary, worked together at the well-known hedge fund Duquesne, run by Stan Druckenmiller. So they're good friends, and I think they share this view that the changes in the U.S. economy through productivity from AI and Trump's deregulatory stance or loosening regulations is going to make the U.S. economy more productive and should allow for lower interest rates. One last point, we've added Australia to the portfolio, Australian fixed income in both the solutions and cautious portfolios. What we like about Australia is the economy's growing, it's a good credit, but they've also just started hiking rates again. And so you now earn about 50 basis points more in Australian debt than you do in the UK. We like what the exchange rate is doing. We expect it will continue to appreciate against the dollar and certainly hold steady against the pound, or perhaps even appreciate against the pound as well. So that's a new feature in the portfolio and something that we feel really good about. So at this point, I'll turn it over to Nick Davis to discuss in greater detail where we're positioned and where we have been making money for you.
So Jeff has talked about the broad economic outlook we're seeing and how we're looking to play that in the portfolios at a broader level. January has been a really good month for us in terms of performance, with the dynamic up over 6% and solutions up nearly 5.5% in terms of returns. The key areas where we've seen drivers of performance which has been very strong in January has been the AI sector, which has been an area of concern and issue for people, and concerns that people have touched on when speaking to us, and we've addressed those and reflected some of those concerns. The biggest performer for us in that sector has been Alibaba, the Chinese company. And again, we've looked outside of the US, and again, one of those concerns we've had is that there will be new providers coming on board, and necessarily the US giant language models will be the core leaders all over the world. Again, the other area we've talked about is technology and chips and the AI and the demand for chips. And one of the strongest performers for again this year so far has been Samsung, which is up 31% so far in January in sterling terms and in Korean won terms. We've looked at alternative ways of playing the AI story, and one of those has been through one, the power demand through the utility companies. We have the broad ETF exposure for European utilities done very well for us. We've also had Scottish and Southern Electricity in the UK, and again, very ordinary utility company, exceptional performance for us so far over the past period of owning the stock and again into January this year. Very pleased with that. The story is panning out and we're playing in that and continue to hold that story. The broader element of electricity and of move towards a greener economy and the power demand from AI, and AI is increasing the demand for power through data centers. We're seeing more growth in that area. Electricity requires copper, and therefore copper has to be mined. So the mining exposure in the portfolios has done particularly well again so far this year. Things like Anglo American and Rio Tinto have done very well. We've also played the broader sector, the investment in a Finnish company called Metso, which is a rock crushing company which helps produce copper from the rock. We look to play across the broader themes, looking for interesting ideas to increase returns from the portfolios. So financials have continued to be a very strong performer this month in January, and we continue to believe they will continue to perform well going into the new year. The key reason behind that is the differential between short-term interest rates, where we're seeing pressure for rates to come lower, and at the longer end of the yield curve, where rates remain consistently higher. This creates a perfect environment for banks in terms of lending. In Europe, we've done very well. Our investment in Piraeus Bank, the Greek bank, has been exceptionally strong again in January, and also investment into Nishi Nippon, a Japanese bank, again which we made towards the end of last year, has had a very good run into January. The area that we've talked about pretty much every time we speak to you is defence, and again defence stocks have had a very strong run for us. As we mentioned, we increased exposure to defence through investments in Lockheed Martin late last year, and again that's had a very good run for us in January. So the key themes that we ran with through last year, which did very well for us and performed very strongly for all the portfolios. At present, we're still very keen on all those themes, as Jeff outlined, for the rationales behind that and our outlook for the economic growth we see coming through, particularly in Europe and also in the US. We look forward to your support in the new year and continued performance of the portfolios.